Hey guys, how's it going? And thanks for coming. I'm Nick, and this is Real Life Money, where we talk about real life and money, because you know schools aren't, so let's get started. So I'd like to first apologize. I usually have a video coming out during the week, but I didn't have time during last week. I had things going on. I was sick. I'm still kind of sick. But I didn't want to get you guys sick, even though that's physically impossible. So I'm back. I didn't leave you guys. And in this video, we're going over the top ETFs to look into for the new year of 2018. So before we get started, what the heck is an ETF? That stands for an exchange traded fund. And basically the easiest way to explain it, like very simply, it is very similar to a mutual fund. So it has like multiple stocks in it, but it trades and acts like a stock, so you can buy and sell it whenever you want during the day. Of course, there are always things more complicated than that, but that's what it essentially is. Kind of mutual fund, acts like a stock. So I picked out a handful of ETFs for you guys to look at if you wanted to get into. If you're a beginner into the stock market, these will be great for you as well. But I got all of these off of Vanguard. Vanguard is an awesome company that you could get investments, even mutual funds, if you want to set up retirement accounts for a very low cost. So I would suggest them. Not that they're a sponsor, maybe in the future, I don't know. But let's get into it, guys. I have some bonds, some stocks, mostly stocks, because I like stocks more than anything else, and a little bit extra at the end. So first, we got a bond ETF. We could see this is Vanguard long-term bond ETF. Right now they're trading around $93. And I have the chart. All of these charts that I'm going to show you are set up for 5 years. So you can see it has ups and downs throughout those 5 years. So this specific bond ETF, that symbol is BLV. So that's for long-term bonds. Now, for me personally, I'm not interested in bonds just because I have a long-term time horizon. People say they're less risky than stocks, and I agree with that in the short term. You know, it might go between, this stock was, well, not stock, this bond ETF is around 93, so it might go down to like 90, it could go up to 95 or something like that. So it definitely could move around like a stock, but doesn't have huge swings. Why I don't care for bonds is that I could make a lot more money in stocks. Even if stocks crash, they could rebound even quicker. So that's why I don't really care for bonds. Now, of course, there are many different type of people out there. If you want less risk, this is definitely something to look into. So I took a picture of this. This shows you the holdings of the ETF. We can see they have AAA, AA, A's. So that is the risk level. So AAA's are very, very safe. And all the way at the bottom, like below B's, if you think of like school, obviously B or lower isn't as good as A's. So they have a bunch in safe bonds, and they have also a huge chunk in triple B's. A little more risky, but has more return. So that's kind of how they have it set up. Now, I'm not going crazy into these guys, so that's kind of where I'm going to end it with that ETF. But at the end of the video, I'm going over all of these ETFs and how they performed, kind of comparing to each other. So I'll let you know how that goes. Moving on to the next one. More of my speed, stocks. Let's look at Vanguard S&P 500 ETF. This mirrors the S&P 500. 500 of the largest companies in America. Again, you can see their 5-year chart. Phenomenal. I love it. Now again, I found all of these on Vanguard. I just retyped these ticker symbols into Yahoo Finance. Just because I use Yahoo Finance more. So, you could see along in Yahoo Finance, you could see the yield. That's the dividend they pay out. Right now is around 1.78, which is pretty good. And a little bit lower down, you could see their expense ratio. And you can see that for all of these. This one is 0.04%. So very, very, very low, which is why I like Vanguard. So the ticker symbol for this, by the way, is VOO, and let's look at their holdings. You could see, and a lot of these might have very similar holdings. But you can see they have Apple, Microsoft, Amazon, so on and so forth. So a bunch of huge companies. And you can see the fund summary to the right, along with all the other ones. So they have large capitalization stocks, and they're, looking at that stuff basically. Now, if you don't want to do too much research, I would definitely suggest that ETF or anything that mirrors the S&P 500. That's considered an index. A lot of people try to beat the index, and they simply don't. So just a simple index, literally no brainer, no research required, and you'll do better than most. So that's why I would suggest that. Definitely. Moving on to the next one. This is more growth oriented. So this is Vanguard Growth ETF, ticker symbol VUG. You can see the chart. Again, phenomenal. Their yield is a little bit lower because it is focused primarily on growth. So it's 1.14%, and their expense ratio, again, very low. Their holdings, very similar, slightly different, but they do have Apple, just like everyone else. They have Amazon, Facebook, Google, and a bunch of those companies as well. So a lot of these do overlap. So that's why, if you choose one, it's not like you're not getting something somewhere else. So just take that into consideration as well. So we looked at the big boys, right, guys? The large companies, the Apples, the Amazons, all those. So a little bit more diversification, another type of investment, still stocks, but instead of large companies, we have the small guys. So we have Vanguard Small Cap ETF. That ticker symbol is VB. You could see even in the chart, it is a little bit more risky. We're going to look at the performances again at the end. But their yield is a 1.35%, and again, expense very low. And real quick, to look at some of their holdings, these are smaller companies, so you might not recognize a few of these or maybe all of them. But again, you can see on the fund summary to the right, they specialize in small capitalization stocks. And I suggested this one as well because large companies, they are great. They have their own type of growth, but this is just slightly different, more risk, and could have more return over the long term. So that's why I kind of threw it in there for you guys. So those were basically American-based companies. Of course, they have things outside of America, but this next one is basically the whole world. So the next one is Vanguard Total World Stock ETF. So not only America, everywhere. That stock symbol is VT. Their chart, again, you could see the dips and valleys. Right now it's doing phenomenal. Their yield is actually better than the other ones we looked at, of a 2.11%. And to look at their holdings, again, you could see a bunch of these are very similar to what we saw before with Apple, Microsoft, Amazon. They threw a little bit extra things in there, like some banks like JP Morgan or Exxon. But they have not only the large guys, they have smaller holdings as well, probably more down the list of than these top 10 holdings. But they have everyone, all those companies in the world. So not just the big guys. So if you're looking for diversification, like what if America does bad, or what if, I don't know, England or China does bad, that kind of has everything together. So if one part of the world goes down, that's okay, because it has basically the other side of the world. Now also realize, kind of a word of wisdom here, is that not all companies have great growth like the countries that we know. Like America has great growth, China has great growth. There are a bunch of other countries as well, but other countries, they have very little growth. They might even have negative growth. So the growth of this total fund might not be as much as other funds, but it is more diversified. Now, the last ETF to diversify you even a little bit more, not just in stocks, this is the little extra one for you guys, is real estate. So we have Vanguard REIT ETF. REIT stands for Real Estate Investment Trust. REITs basically invest in properties, so they give out rent basically. So it's kind of more of an income related ETF. So you could see their 5-year chart. It is a little bit different than the other charts that we looked at. So it is a little bit more stable. Their yield much higher than the other ones because, like I said before, it is kind of more income and rent related. So their yield is around 4.25%. Expense a little bit higher than the other ones, but still relatively low. So their holdings, again, you might not recognize any of these, but you could see, Vanguard REIT 2 index. So those are basically a bunch of real estate investment trusts. But looking to the right, you can see that the investment seeks to provide a high level of income and moderate long-term capital appreciation. So it doesn't have huge growth, but it does have a high level of income. So depending on what you're really looking for, and if you want to diversify, this is an option. So those are the handful of ETFs that I chose out for you guys. How did they perform? Well, let's look at them. Again, this is all seen on Yahoo Finance. There's a top bar. You could click performance, which I'm going to show you right now. So this is the first guy that we looked at before, the long-term bond. This is BLV, and you could see their return. This fund was first started in 2008, but I averaged this out for you guys. Their average was 7.64%. The next bad boy is the S&P 500, ticker symbol VOO. Their average return was around 14.16%. And just realized that this did start after the 2008 crash. So this return might seem high, but it didn't factor in that crash because it started in 2011. The next one, Total Market. This is VTI. Their average return is 9.83%, and you could see those red marks that no one really likes, but that factors in the crash in 2008 as well. A little bit of growth going on with VUG. Their average is 11.12%. And the small guys, the small cap, VB, their average return is 11.12% as well, actually, which is the same as the growth that we just looked at. And this is the total world. Everybody's in the pot with this one. VT, their average return is a 12.70%. And last but not least, Real Estate Investment Trust, VNQ, that average return was 9.76%. So which one should you choose? Here's the thing, guys. These results are slightly skewed. Not even slightly. They are skewed because they started at different times. Some started before the crash. Some started after the crash. So ETFs are relatively new. So like if you just looked at what performed the best out of these, the best was the S&P 500, VOO. But here's the thing, you can't really predict which is going to be the best one. Are bigger companies going to do better than smaller companies? Or is real estate going to do better than, the total market of the world or whatever? So instead of trying to pick which is going to do the best, I would suggest diversifying. So have some in the index, have some in growth, have some in small cap. Because you really don't know. So instead of trying to pick out the winners, when you have them all, you're always going to have a winner in there somewhere. So that's my suggestion. So if you have like a retirement account, a Roth IRA or 401k, you could kind of split it up in between these types of things. Maybe not these specific ETFs, or if you want to set up a Roth through Vanguard, you could get these. But this type of diversification you could do anywhere. If you want some small cap, large cap, mix it up. And that's kind of it, guys. Even if you invest in any of these things, it's gonna be better than a stupid savings account. I could guarantee you that. So if you have any questions, comments, concerns, please leave them down below. I'd love to hear what you guys have to say. And don't forget to subscribe to my channel, Real Life Money, where we talk about real life and money, because I believe we could get a hold of our money and stop following the man. So thank you so much for watching, and I'll see you in the next one.